The tape is moving, and right now, as we speak, Alibaba Group Holding Ltd ADR, ticker symbol BABA on the New York Stock Exchange, is trading at $152.93 USD. We are seeing a slight intraday pullback of roughly 35 cents, or 0.23%, swinging in a tight range between $148.64 and $155.88 throughout this Monday session. If you are just tuning in, you might look at that red number and think the bears are in control, but that would be a surface-level read that misses the massive tectonic plates shifting underneath this stock right now. The expectation on the street, especially after the volatility we saw last week following the White House memo reports, is that Alibaba is dead money walking into tomorrow's earnings print. The narrative being pushed by the headlines is one of fear. Fear of delisting, fear of geopolitical crossfire, and fear that the Chinese consumer is tapped out. But the reality? The reality is substantially more complex and, frankly, more interesting for anyone willing to look past the panic. We are sitting at $152.93, a level that would have seemed impossible to the bears back in 2024, yet here we are. The market is pricing in a wait-and-see approach just hours before what might be the most critical earnings call of the fiscal year. You have to ask yourself, if the news is so bad, why isn't the stock trading back in the double digits? Why is it holding the $150 line with such ferocity? That is the curiosity loop you need to be stuck in right now. The general belief is that Chinese tech is uninvestable due to the PLA memo leaks from earlier this month, but the price action tells a story of accumulation, not capitulation. We are seeing smart money absorbing the retail panic selling, while the average retail trader on Robinhood might be hitting the sell button because they saw a scary headline about national security. The order flow data suggests that institutional desks are quietly stepping in to defend this zone. Let's break down the immediate price action we are seeing today. The stock opened at $151.98, dipped to verify support at $148.64, a critical technical level that aligns with the 50-day moving average, and then bounced back above $152. This demonstrates that there is a heavy bid sitting right under $150. Traders using interactive brokers to track the Level 2 data are likely seeing large block orders sitting on the bid side, preventing a washout. This isn't a stock in freefall. It is a stock in compression. It is a coiled spring waiting for a catalyst, and that catalyst is arriving tomorrow morning. The tension in the market right now is palpable. We are sandwiched between two massive opposing forces. On one side, you have the geopolitical headwinds, specifically the November 14th Financial Times report alleging Alibaba's technology was used by the Chinese military. That report alone knocked the stock down from the 160s. On the other side, you have the macro tailwinds from the recent Trump-Xi trade truce and the Phase 2 stimulus packages Beijing has been rolling out to subsidize energy costs for AI data centers. This is the battleground. The bulls are betting that the earnings tomorrow will show that the cloud division is finally monetizing its AI infrastructure at scale, rendering the political noise irrelevant. The bears are betting that the guidance will be cut due to U.S. sanctions fears. Now, before we get into the weeds of the business model, let's talk about the psychology of holding this stock. If you are holding Alibaba stock in your Fidelity brokerage account, or perhaps as part of a Schwab Intelligent Portfolio strategy, you have likely been sweating. The volatility in BABA is not for the faint of heart. It requires a stomach for massive swings. But look at the volume today. Over 16 million shares traded already. That is healthy. It is not anemic. It shows active participation. The market is trying to figure out if $152 is the floor or the ceiling. My take? It looks like a floor. When a stock refuses to drop on bad news, and let's be honest, accusations of military cooperation are very bad news, that is usually a sign of seller exhaustion. The people who want it out are already out. Who's left? The conviction holders. Let's shift gears to the macro environment, because you cannot trade BABA in a vacuum. You have to understand the Beijing put. Just a few days ago, we got confirmation that the Chinese government is increasing subsidies for domestic semiconductor usage and data center energy costs. Who is the biggest beneficiary of that? Alibaba Cloud. While Nvidia stock gets all the glory in the US for the AI boom, Alibaba is effectively the landlord of the Chinese AI ecosystem. They are building the infrastructure that every other Chinese startup is renting. If Beijing is subsidizing that electricity, that flows directly to Alibaba's bottom line. This is a margin expansion story that the market is currently ignoring because it's too focused on the political drama. And speaking of drama, let's address the elephant in the room, the White House memo. On November 14th, reports surfaced that declassified intelligence linked Alibaba to the PLA. The stock took a hit that day, dropping nearly 4%. But here's the contrarian take. We have heard this song before. We heard it in 2020. We heard it in 2022. Every time these headlines drop, the stock tanks, and every time the business continues to operate. If the US government was going to fully sanction Alibaba, they likely would have done it years ago. The fact that they are leaking memos rather than imposing an OFAC designation suggests this is leverage for trade negotiations, not a death sentence for the company. If you are selling your shares on SoFi because of a leaked memo, you might be playing right into the hands of the algorithmic trading bots that feed on sentiment-based capitulation. Comment below right now. Do you think the White House allegations are a legitimate threat to Alibaba's existence, or is this just another political bargaining chip in the trade war? I want to hear your thoughts. Are you buying the fear or selling the news? Now, let's look at the business fundamentals that are often overshadowed by the stock price volatility. Alibaba is not just an e-commerce company anymore, it is a data utility. Yes, Taobao and Tmall are the cash cows, turning out billions in free cash flow that allows the company to buy back shares aggressively. But the growth engine, the reason you own this stock instead of a boring utility, is the Cloud Intelligence Group. We are seeing a shift in how they report earnings. It is no longer about gross merchandise value, it's about cloud revenue per user and AI model adoption. Think about how you use Amazon stock as a proxy for AWS. You should be using BABA as a proxy for Aliyun, Alibaba Cloud. They recently launched the upgraded QN AI Assistant, which is being integrated across their entire ecosystem, from logistics in Cainiao to customer service in Tmall. This isn't just a chatbot. It is an enterprise-grade productivity layer that they are selling to millions of businesses in China. When you analyze the earnings preview for tomorrow, don't just look at the top-line revenue. Look at the cloud margins. If those margins are expanding, it means their AI bet is paying off. The competition is fierce, absolutely. You have Pinduoduo, PDD, nipping at their heels in the low-end e-commerce market, and you have ByteDance, TikTok's parent, stealing ad dollars. But Alibaba has something those competitors don't have: a fully integrated logistics and cloud backbone. Pinduoduo has to rent servers. Alibaba owns them. JD has to build warehouses. Alibaba's Cainiao network already orchestrates them. This vertical integration is a defensive moat that is wider than most people realize. When you are looking at your investment options on Robinhood or Webull, it's easy to chase the faster growth of a PDD, but PDD is pure retail exposure. Alibaba is an infrastructure play. Let's talk about the Trump trade aspect of this. We know from the search results that in this timeline, Trump is back in office and has already met with Xi Jinping earlier this month. A trade truce was agreed upon. This is arguably the most bullish signal for Chinese ADRs we have seen in 5 years. Why? Because uncertainty is the killer of valuation. If the market knows the tariffs are capped or that a deal is in place, the risk premium on BABA evaporates. The stock is currently trading at a PE of roughly 17x. Historically, BABA traded at 25x or 30x. If that risk premium comes off because of the political truce, you could see a multiple expansion that drives the stock to $180 or $200 without a single dollar of extra earnings. It is purely a sentiment re-rating. However, we must remain objective. We cannot ignore the technical breakdown that happened last week. The stock failed to hold the $160 level. In technical analysis terms, that was a failed breakout. It trapped a lot of bulls who bought the breakout, and those bulls are now sitting on losses, waiting to sell at break-even. This creates overhead supply. As the stock tries to climb back up, it has to chew through all those sell orders from frustrated traders who just want to get their money back. That is why the $158 level is going to be such a tough nut to crack. If we get a strong earnings report tomorrow, we might gap up over that resistance. If we gap over $158, the short sellers, and there are a lot of them, will be forced to cover. Short interest in BABA has been creeping up. The bears are emboldened by the military allegations. If the company comes out tomorrow and announces a massive increase in the share buyback program, essentially saying, "We don't care about the memo, our stock is cheap," that could trigger a short squeeze. We have seen Alibaba management get more aggressive with buybacks recently. They have billions of dollars in cash sitting on the balance sheet earning interest. Investors have been